Every financial fire needs a spark. In the early 2000s, banks and hedge funds found a matchbook with a friendly label. Credit default swaps, like insurance for bonds. Pay a small premium, sleep easy, risk transferred. But here's the paradox. With a CDS, you don't have to own the bond you're insuring. You can buy protection on your neighbor's house and then hope it burns. So the question isn't just what a CDS is supposed to do. The question is what it does to people once you hand it to them. Is this insurance that stabilizes markets or a device that turns everyone into a quiet arsonist waiting for oxygen? This is the markets and machines historian, where money, power, and history collide. And nothing is as simple as it looks. Credit default swaps are sold as safety valves. In practice, they rewired the global credit system, accelerated crises, and turned trust into something you could trade by the slice. Follow the chain long enough and something unsettling appears. The line between hedging risk and manufacturing it is paper thin. And when that line blurs, someone always gets rich, but rarely the public. To understand how a bland-sounding contract could move nations, go back to the beginning. In the 1990s, big banks had a balance sheet problem. They were overexposed to the same giant corporate borrowers, and regulation nudged them to reduce concentrated risk without losing lucrative client relationships. A clever workaround emerged. Keep making the loans, but lay off the risk somewhere else. Enter the modern credit default swap. Two parties sign a contract, one pays periodic premiums, the other promises to compensate if the borrower defaults. On paper, the bank keeps its customer and sheds its risk, transforming chunky loans into smooth, tradable exposure. The contract looked like a hedge, a humble safety belt, but the design contained a small hinge that would swing open a much larger door. You didn't need to own the bond to buy the swap. You could insure what you didn't possess. That small hinge changed behavior. If you can short a company's credit without touching the bond, you've created a new way to bet against survival. Liquidity flooded in. Spreads became a scoreboard. Protection buyers could express doubt in seconds. Protection sellers could earn a steady premium that felt like free money in calm seas. This was the quiet transformation. Once risk becomes tradable, it becomes drivable. And once a price can be driven, it becomes a tool. Strip away the jargon, and the mechanics are simple. The buyer of protection pays a regular fee. The seller promises to make the buyer whole if the reference company or country defaults. If default hits, the parties either exchange the defaulted bond for its original value, or agree on a cash payout equal to the loss. Between these endpoints lives a landscape of incentives and traps. The first trap is basis, the difference between a bond's yield and the cost of its CDS. When that gap is small, traders feel safe levering it up. Buy the bond, buy protection, capture what seems like a riskless spread. But the basis is a fair weather friend. When liquidity vanishes, the relationship between the bond and the CDS breaks, and the tidy little spread turns into a falling elevator. The second trap is correlation, the hidden force that lurks in tranquil times and leaps out during crises. If one mortgage pool can crack, maybe many will. If one company misses, perhaps it's not idiosyncratic but systemic. That fear led to tranches and synthetic structures that multiplied exposure. For every real bond, multiple layers of CDS could be stacked on top, like mirrors facing mirrors, creating not just a reflection of risk, but a hall of it. The third trap is the simplest, covered versus naked. When the CDS protects a bond you actually hold, it's a hedge. When you're insuring a stranger's house, it's a wager, and wagers reshape the world they bet on. By the mid-2000s, the device had escaped the lab. Corporate credit wasn't enough. The market strapped CDS onto mortgage-backed securities and their tranches, especially the ones blessed as nearly bulletproof. Premiums trickled in. Models nodded. Defaults were dismissed as statistically remote. Institutions like AIG wrote protection on mountains of supposedly safe slices, reasoning that the world of housing could wobble without falling. Then the wobble became a crack, and the crack a canyon. Correlations shot toward one as mortgage losses emerged. The safest tranches were revealed as kindling arranged in geometric patterns. When payers of protection couldn't meet their obligations without external rescue, governments stepped in, backstopping the inferno. The premium had been privatized. The conflagration was socialized. The rhetoric said hedging, but the balance of pain said something else. When an instrument promises calm and hands you leverage instead, it isn't a seatbelt. It's a nitrous switch next to the fuel line. The story didn't end with banks or homeowners. It graduated to countries. When CDS leapt from corporations to sovereigns, a credit spread became a political headline. A rising sovereign CDS doesn't just reflect worry, it can create it. Wider spreads mean higher borrowing costs, collateral calls. For institutions holding that country's debt, intense press conferences where finance ministers insist the fundamentals are sound. Some swear this is pure truth-telling, a market simply diagnosing sickness early. Others argue it's a self-fulfilling prophecy, a machine that can make the disease by loudly pricing it. Buy enough protection, move the spread, unsettle funding, and then point to the turmoil as proof your fears were justified. Diversification, the soothing word of modern finance, became a mirage. In normal times, correlations are mild and diversification looks wise. In stress, correlations sprint toward one, and all the careful slicing becomes different routes to the same locked exit. The sleight of hand converts credit, the slow fundamental question of whether a borrower can pay over years, into volatility, the fast, tradable motion of spreads today. Once the system lives in volatility, the horizon shrinks. The question is no longer, will the borrower repay? It's, can the spread cooperate long enough to roll the debt? Well, if the market stops investing and starts gaming. To be fair, CDS can do useful work in a cleaner world. A pension fund genuinely exposed to a company's bonds might buy protection to smooth funding. A bank may use the CDS market to mark its loan book more honestly than internal models would prefer. Dealers stand ready to warehouse risk and grease the issuance of new debt. In a system with limited leverage, transparent collateral, and contracts tied to real exposure, a CDS behaves like a seatbelt. It doesn't make you reckless. It makes a collision survivable. But the world we live in isn't clean. The leverage hides in footnotes. Collateral moves through pipes only a handful of insiders understand. A rumor, true or not, becomes a funding reality because the instrument that supposedly diagnoses trouble also changes the patient's vital signs. Or consider a country stumbling into a messy budget fight. The sovereign CDS widens, auction demand softens, rating agencies clear their throats, and television panels fill with the word speculators. Those with optionality, cash reserves, borrowing capacity, mandates that allow them to buy volatility, harvest panic. Those with fixed obligations, who must post collateral when spreads move, sell the very assets they wish to keep to fund hedges that aren't hedges anymore. The poker table metaphor holds. Each player borrowed chips from the next, and the game only works as long as no one stands up. Hold dry powder not as pessimism, but as strategy, because when volatility spikes, the best assets move from weak hands to strong ones at the speed of a margin call. Treat a sudden CDS spike not as a mere quote, but as a governance event. It will change lender behavior, covenant math, and executive decisions faster than a board memo ever could. And beware of narrative leverage, the potent mix of headlines, CDS screens, and refinancing calendars that can turn a manageable problem into an existential one in a single news cycle. So, which is it? Insurance or arson? The uncomfortable answer is both. When tied to genuine exposure, transparent collateral, and limited leverage, CDS can stabilize portfolios and expose complacency. Spreads are the heartbeat of rollover, and rollover is the circulatory system of leverage. The boundary between the hedger trying to survive and the trader hoping for smoke has blurred beyond recognition because both are staring at the same dial and acting on it. Debt once meant bondage. Today it means balance, so long as the market believes. The Florentine houses of finance taught that even sophisticated systems can collapse when everyone leans on the same assumptions. The mortgage machine proved that safe slices multiply danger when the underlying story changes. Sovereign spasms show that a country's credit is partly economics and partly narrative, and that a tradable narrative can tighten the noose. The reality lives in the wiring and in the people paid to pull it. Networks of collateral and clearing, windows of liquidity that disappear when shouted at, structures that promise protection until the moment they require it. These are not footnotes. They are the system. Once trust is turned into a spread, you can chart, slice, and lever. The conversation shifts from, can this borrower pay? Because in finance, the measuring stick moves the race. So the final answer is a choice about how to live in a room with matches. Use them to light the way through dark patches, to hedge the exposures you truly carry, to signal danger early without cheering for it, or flick them at curtains and call the glow price discovery. As one path turns a CDS into a seatbelt, the other straps the seatbelt across a can of fuel and calls the acceleration liquidity. Now, the market will always contain both impulses. The difference is whose structure survives when the sirens start and the air tastes like smoke. If the lesson lands, it isn't to fear every flame. It's to understand what burns, what doesn't, and who controls the oxygen. A CDS can be a tool for stability if embedded in a system that forces skin in the game, limits leverage, and treats liquidity as a seasonal river rather than a permanent lake. It becomes arson when used to move the dial for its own sake, when the payoff improves as the neighborhood catches fire, when the loop between quote and consequence is the whole thesis. The modern financial system is filled with such loops. The wise learn to spot them, to step back when the feedback whine gets loud, and to keep enough water on hand to buy the house when the crowd runs for the exits. Every crisis is a transfer, from the many who trusted to the few who prepared, from paper promises to tangible value, from passive belief to active structure. Credit default swaps didn't invent that transfer. They made it tradable, and then they made the trading itself a cause. The instrument is neutral ink on paper until someone needs to roll their debt tomorrow morning. Then the number on the screen becomes the weather, and the weather becomes a policy. If the balance holds, the match stays unlit. If confidence breaks, history reminds what CDS really are. Promises about promises, exquisitely calibrated to work until the moment they don't. After that realization shifted the frame, remember the rule the system hopes you forget. History has the answers. Look where the incentives point, and you'll find who's holding the match.